The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to Nova 401k Associates webinar, Plan Design Features to Consider for 2021. This will be presented today by Mark Larson, the Assistant Team Leader for our Combo team, and Sue Harper, a Senior Account Manager out of our Dallas office. Today's webinar is eligible for Texas CPA Credit. If you would like a certificate of attendance, you must be registered individually, remain on the session for the entire webinar, and complete the survey that will be sent out 1 hour after the webinar closes. For your convenience, we have added the slides as a PDF handout that are available for download during the presentation. Just click the handout drop-down in your GoToWebinar panel and download and save a copy to your local computer. If you have any questions, please type them in the questions box and Mark and Sue will answer them at the end of the presentation. Sue, we're ready when you are.
Thanks, Jasmine, and thank you everybody for attending today. As Jasmine said, we're meeting today to talk about plan design considerations for 2021. If you want to forward the slide, please. First of all, our NOVA disclaimer. The information in the presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional, such as an attorney or accountant, if you do need legal or tax advice. All right, next slide, please. As Jasmine said, this webinar is eligible for Texas CPA Credit. NOVA's provider number is 009820. You must be registered individually, be present for the entire webinar, return the evaluation form, and you should receive your certification within 1 week to get that credit. Next slide, please. So first of all, our agenda. Why are we here today? Why consider changes? If your plan is working the way you want it to right now, why should you even look at changes? Something we'll go over. The current limits, the limits that employees can contribute and employers can contribute to a retirement plan, we'll be going through those. Various plan design considerations. Maybe you have some of these in your plan already. Maybe you don't, but we'll go through a few different ones. Plan amendment requirements, and then questions. If we have time, we'll answer whatever questions we can today, and if not, we will make sure that we get answers back to you for those questions that are outstanding. So next slide, please. Today, we're hoping that you understand and learn the reasons why certain changes in a qualified plan should even be considered. Identify some plan design considerations and where they might make sense in a qualified plan or in your plan, and understand the process and timing for optional plan amendments and required plan amendments. So we'll be going through those things today. Next slide. First of all, why consider changes? Maybe right now your plan isn't as effective as you would like it to be. Maybe you want to increase participation or have the employees that are contributing be able to contribute more. It might be a reason to make a change. Current state of the economy. Right now, things are so all over the board. Some businesses are booming, some businesses are struggling. It might be time to make a change to your retirement plan just to better meet the needs of the plan. Changes in regulations. Later on in the webinar, we will be going through a few different acts that have been passed, especially related to the coronavirus, things that can impact the retirement plan. Vendor system automations. Maybe your payroll company is able to help you out with automatic enrollment, so it might be time to look at that, or online distributions. Maybe your record keeper can help you with those now a little bit easier than they could in the past. Just some things to think about regarding your retirement plan. You might want to change your plan to help recruit and retain top talent. Some businesses are still hiring and they're still looking for good people, and the retirement plan can be a really great benefit and a reason why somebody might tip their hat towards your company rather than a different company. And then two, maybe employees are requesting a change. Maybe you don't currently offer a Roth option, but employees are mentioning that they might like to have that. So those are just some of the different reasons to change your retirement plan. Next slide, please. Thank you. All right, first of all, for the current limits, so for 2020, these are amounts that can be contributed to a retirement plan. A participant out of their own pay can contribute $19,500 if they're age 50 or over. So if they hit age 50 during 2020, they can contribute an additional $6,500. Compensation limit is $285,000. And we use that compensation limit in a couple of places. One of them is for some compliance testing that we do. And the other time we use it is if we are calculating a profit sharing contribution. Maybe there's a participant in the plan who makes $600,000 and the plan does a 3% profit sharing contribution, so contributes 3% of an employee's compensation. That employee would get a 3% contribution of $285,000, not 3% of their entire compensation. So there's a limit on that. The annual limit is $57,000 plus catch-up. So what that is the amount that a participant can get into the plan for 2020 that includes that 401k limit of $19,500. So the most an employee can get into the plan between employee and employer contributions is $57,000 plus that catch-up amount if they're age 50. The limits for 2021 will be released in October or November. Typically they come out during that time, and we are expecting that this year as well. So, all right, next slide, please. All right, one of the changes that can be made is you could change eligibility to increase participation. A lot of plans in the past have had eligibility of 1 year of service, so an employee would have to work 1 year with 1,000 hours. They'd have to be age 21, and then they would be eligible to enter the plan either January 1st or July 1st. That's what plans usually were. Eligibility can be much more flexible than that. And in some cases, it might help to have a lesser eligibility. It helps your employees or your participants to save for retirement, might help in some of the non-discrimination testing, and it might even be helpful in attracting potential employees. If you're looking at hiring somebody who's been eligible for the plan where they currently are right now, and the plan that you have doesn't allow them to be eligible for a year, that can be kind of something they may not like. Eligibility can go anywhere from a person will be eligible on the date of hire to, like I said, in the past, typical was usually 1 year. Couple things to look at though, or to remember if you do make eligibility more frequent. If the plan does a match or a profit sharing, the cost of those contributions will go up because you have more people that are in the plan. And you should also kind of look at the overall benefit versus the overall cost, just to make sure that maybe you change eligibility to 90 days, and then they can enter the month after they work 90 days. Make sure that adding those employees in there sooner benefits the plan overall and covers the overall cost. So, all right, next slide, please. There is a workaround as far as the rising match or profit sharing cost. If you allow employees to enter a little more frequently, the workaround is dual eligibility. Kind of just like what it sounds, you have two different types of eligibility. Maybe you use a lesser eligibility on the 401k deferrals, but you keep that stringent eligibility on the employer contributions. So maybe employees are eligible for the plan after 3 months of service to contribute out of their own pay, but maybe they are not eligible for match until they've been employed for a year. Something that you can do. One note though, dual eligibility will invalidate the top-heavy minimum contribution being met via safe harbor contribution. Top-heavy is another type of compliance testing that we have to do, and if the plan fails the top-heavy test, an employer contribution has to be made to, or should be made to those, to the non-highly compensated employees. If they are eligible for the plan, even if it's only to contribute out of their own pay, they would also be eligible for a top-heavy contribution. So next slide, please. All right. Another change that you maybe could consider is testing method options. Another compliance test that we have to do on plans each year is called the ADP and ACP test. ADP stands for Average Deferral Percentage Test, and that is where we look at compare the rate that the highly compensated employees, or HCEs, are contributing to the plan versus the non-highly compensated employees, the NHCEs. The way the test kind of works generally is that the HCEs are allowed on average to contribute about 2% more than what the NHCEs contribute as an average. So one of the things when we say testing method options, one of the things we look at is prior year testing. That allows for the plan to be able to do a little bit of planning. It's kind of like it sounds. We would look at what the NHCEs contributed in the prior year. Say as an average, they contributed 5%. So we would know for 2020 then, or for the next year, that the highly compensated employees as a group could average contributions of 7%. It's just a good planning tool, a way to know kind of what the highly compensated employees can contribute in a year as an average. The other option is current year testing, and that's we look at what the NHCs contributed in, say, 2020 versus what the HCEs contributed in 2020, and they can only have that 2%. Typically, it's a 2% difference. One of the advantages of the current year testing is maybe there is a year that, and it could even be this year, employee contributions are down or participant contributions are down because maybe they aren't working as many hours, or maybe the pay was reduced a little bit. If you do a prior year testing, the non-highlies percentage for 2020 may be low this year, so that would really reduce the amount that the highlies could contribute in 2021. One of the tests we do is, as I said, the ADP test. The other test is the ACP test. And the ACP test is that same test, just on the matching portion that an employee receives. So, next slide, please. All right. And another option that can be added to a plan is Safe Harbor 401k plans. Now, Safe Harbor is used in a few different ways when it comes to retirement plans, but what we're talking about when we say a Safe Harbor 401k plan is an option within the plan. The Safe Harbor plans were first introduced in 1999, and they can be a real good benefit for plan sponsors with low participation among the non-highly compensated employees. And if they fail that ADP test that we talked about, typically a refund would have to be given to the highly compensated employees. Safe Harbor plans can reduce that. Highly compensated employees can contribute maximum, so up to that IRS maximum, and they can avoid refunds. Next slide, please. All right, with Safe Harbor 401k plans, it's a contribution that the plan agrees to give the eligible participants in the plan. And there are a few different options that would qualify a plan to be a Safe Harbor plan. The first one is a Safe Harbor non-elective contribution. And what that is 3% of compensation to all eligible participants. So as long as they're eligible for the plan, they would receive a 3% contribution on their compensation for that year. It can be deposited per payroll. It can be deposited at the end of the year. That's an option that we would set up in the plan as well. The other contribution options are actually a match. There is what's called a Safe Harbor basic match, 100% of the amount an employee contributes up to 3%, plus 50% of what they contribute on the amounts between 3 and 5%. So basically, if an employee contributes 5% out of their own pay, the plan would match and put in a 4% match for that employee. The other option, besides the basic match, is an enhanced match. And typically that would be 100% of deferrals up to 4% of compensation. It could be up to 5%. There are some limits, but it's just another way of providing a match to the employees that would allow the plan some leeway on the compliance testing. So, next slide, please. All right. Some of the benefits of 401k plans, as I said, it does avoid refunds at year end for highly compensated employees, including the limits on highly compensated employees. So when we were talking about the testing before, and I mentioned that the highly compensated are limited by what the non-highly compensated employees contribute, with the Safe Harbor plan, there isn't that. There's not a limit. The only limit would be the 19,500. They wouldn't be limited by a certain percentage. Safe Harbor plans can also satisfy top-heavy requirements if no other employer contributions are made. So it can be a benefit that way. And Safe Harbor plans might also satisfy contribution requirements for what we call new comparability contributions. New comparability contributions is a type of profit sharing contribution that can be calculated for the plan. And with that, one of the requirements of that type of a calculation and that contribution is a minimum gateway, minimum contribution to all employees. And if the plan is doing a Safe Harbor non-elective contribution, that 3% can be counted towards that minimum gateway. So it can help in a profit sharing calculation actually also. So, next slide, please. All right, things to consider and remember with a Safe Harbor 401k plan. It has a lot of great benefits, but there are a few things to remember. Those contributions that I mentioned, the non-elective or that basic or enhanced max, those are required employer contributions. So in the plan document, we would be selecting a contribution, a Safe Harbor contribution. So that contribution is a part of your document and it would be required to be done. Another thing to remember, there's no service or no hour requirement for that contribution. A lot of times with a match or profit sharing, the plan document can state that an employee has to be employed on the last day of the year, or they have to work 1,000 hours during the year to get that contribution. Safe Harbor, as long as the participant is eligible for the plan and eligible for the Safe Harbor contribution, they would receive it. It does not matter how many hours they work during the year, and it doesn't matter if they're employed on the last day of the year. Safe Harbor contributions are always 100% vested. With other types of employer contributions, a vesting schedule can be applied, and an employee has to work there a certain number of years before they're fully vested in those contributions. Safe Harbor, they are 100% vested as soon as they're eligible and those contributions are made. We'll be talking about this one a little bit coming up. Might elect the Safe Harbor non-elective later in the year, where typically in the past you've always had to elect that option before the year starts. There is a maybe notice. That's an option in the plan as well. You can do a Safe Harbor maybe and determine later on during the year that you may or may not be Safe Harbor. And another thing to consider with Safe Harbor plans is mid-year plan amendments are restricted. So if you don't have that Safe Harbor, you can make changes to your plan mid-year. With Safe Harbor plans, a little bit more restriction on what types of changes could be made. You aren't able to take away any benefits. You aren't able to change the way benefits or change the way contributions are done typically. So just a little bit more restrictive. Once a plan is Safe Harbor for a year, it should really stay Safe Harbor and stay as it was at the beginning of the year. So, next slide, please. All right. And as I said in the beginning, there's a few different acts we'll be talking about. Mark will be going into those more often. But one of the acts that was passed this year, the Secure Act, impacts safe harbor contributions. In the past, for safe harbor contributions, if a plan is a safe harbor plan, a notice had to be given to all employees, all eligible employees, before the beginning of the year to let them know about that contribution, what it is, and just a few of the plan provisions. With the Secure Act, the annual notice requirement is eliminated for safe harbor non-elective. It's still required if the plan does a safe harbor match and maybe plan, but if it's safe harbor non-elective, an annual notice does not have to be given. Another thing that the Secure Act changed is the ability to amend to a safe harbor non-elective plan during the year up to 30 days before the year ends. In the past, again, typically if you were going to do a 3% safe harbor non-elective contribution, you would, for 2020, you would have to determine that in November of 2019 in order to give the notice to the employees. That's no longer the case, actually. You can now determine up to November of 2020 that you would like to be a safe harbor non-elective for the 2020 plan year. You would have to do a 3% contribution on compensation for all eligible employees, but you can determine it later on during the year. And then actually, this was another part of the Secure Act. You can amend the plan to be safe harbor non-elective for the prior year. So next March, when we're doing the compliance testing for your plan, if the ADP test would fail and the highly compensated employees are due refunds, you could actually amend the plan for 2020 to a safe harbor non-elective plan with a 4% contribution. That's the one caveat. It would, if you do it after the year is done, it has to be a 4% contribution to all eligible employees. The main benefit, though, instead of people having to get refunds, they could be a safe harbor plan and no refunds would be needed. So, next slide, please. All right, and then from safe harbor, we're going to move on to Roth 401k contributions. A lot of people have probably heard of Roth. It's a lot more known than it used to be. Roth was first introduced in 2006. Benefits of Roth 401ks include tax-free growth, which can really benefit employees in a lower tax bracket but anticipate being in a higher tax bracket in retirement. It also offers the ability to diversify accounts for tax treatment using a combination of traditional or pre-tax 401k and Roth 401k. Employees, it might not be a bad idea to have a bit of pre-tax money and a bit of after-tax money. So when they are in retirement, maybe they want to keep their income level below a certain amount. They could take pre-tax money up into that amount and then take after-tax money out after that, kind of save some taxes. With that Roth money, taxes have been paid on it when you contribute to the plan, and as long as it's a qualified Roth distribution, you would no longer pay taxes on the money you contribute or the earnings on that money. So, next slide, please. In addition, for those who are interested, but maybe they can't currently participate in a Roth IRA because of income limits, the Roth 401k could be a really good option for them. In an IRA, you're limited to the IRA limits. With a Roth 401k, an employee or a participant can contribute that $19,500 plus the catch-up if they would like to. Now, Roth and pre-tax are combined together for that $19,500 limit, but if an employee is really looking to get some after-tax money in, the Roth 401k would allow them to get more money than just a Roth IRA. And then also, as I had mentioned, there's no income limits on the Roth 401k. Doesn't matter if a participant makes $300,000 where maybe you couldn't normally contribute to a Roth IRA, you can still contribute to the Roth 401k. Next slide, please. And then kind of a side-by-side comparison of Roth and pre-tax. Roth, as we said, after tax, traditional 401k plan was always pre-tax contributions. Neither one of them has any income limitation to participate. It doesn't matter how much your compensation is. You can, as long as you're eligible, you can participate. Both of them have that $19,500 limit for 2020 plus catch-up dollars. Advantage of a Roth: withdrawals and contributions and investment growth are not taxed as long as the participant has a qualified distribution, which would be they are at least age 59 and a half and the account has been held for at least 5 years. With traditional or pre-tax money that goes into the plan, withdrawals are subject to federal and most state income taxes. Because the money went into the plan pre-tax, you have to pay tax when you take it out. The other thing where both pre-tax and Roth are the same is required minimum distributions are still required with both Roth and with pre-tax money. I do have a little note in here about age 70 and a half or 72, depending on when you reach age 70 and a half. And that was a change just this year due to one of the acts. So next slide, please. All right, some things to consider if you're thinking about Roth. If maybe it's not currently an option on the plan, but you think it might be something that you would want to add to the plan. It is an additional money source to track for payroll purposes and your vendor record keeper. Pretty much all record keepers can definitely handle it. And if an employee is contributing as Roth or a participant's contributing as Roth, when they look at their statement or they look online at their account, they will see a money source that specifically says Roth. It is tracked totally separate from their pre-tax money. A participant can elect different percentages for traditional and 401k contributions, traditional or Roth 401k, and they can maybe do 5% Roth, 2% traditional, or whatever, however they would choose. So the payroll system just has to be able to handle something like that. Roth contributions do not eliminate the ADP testing requirements. They're tested and counted in as a contribution just like pre-tax money would. If the plan does a company match on money contributed, that match is also figured on Roth contributions. So the match would still go in as pre-tax, but if an employee or a participant is contributing Roth dollars, it's counted on. The match would be calculated on that. We'll talk about Roth conversions next. Became effective in 2010 without income limits. And then one big thing with Roth contributions is just employee education. It can be a really great benefit for a lot of employees. Employees just have to understand how it works and how it's going to benefit them. So next slide, please. All right, Roth 401k conversions. This, again, started in 2010. Plans can amend their plan, or employers can amend their plan to allow for in-plan Roth conversions. It's definitely not a requirement. It's just something that plans could offer. And what it does, actually, if you could go to the next slide, please. The plans must already offer a Roth 401k contribution option. The plan is not required to do tax withholding. So an employee would decide that they want to convert $10,000 in pre-tax and make that Roth money, and they can do that. The plan would not withhold any taxes at that time. So at the end of the year, the employee would be responsible for taxes on those amounts. It would be considered income for them, that conversion amount. So something that employees have to keep in mind and something that they should be educated on. The plan must also be amended by the last day of the year in which that amendment is effective. So next slide, please. And actually, this is where Mark is going to start. So Mark, if you want to go ahead.
Thank you, Sue. Let's go ahead and transition now to automatic enrollment. Again, I want to thank everyone today for taking time out of your busy day to join us here at NOVA. Automatic enrollment is a feature in a retirement plan that allows an employer to enroll all eligible employees in a retirement plan unless the employee affirmatively elects otherwise. Studies by our friends with behavioral economists have determined that employees are 92% more likely to accept the automatic feature rather than make the effort to decline. Therefore, by taking advantage of human nature, that being not wanting to change, automatic enrollment serves to overcome a worker's inaction, forgetfulness, or even procrastination. So with auto-enrollment, doing nothing can actually become a positive choice. With more than 10 years of data to review, recent studies have shown that 401k plans with an auto-enrollment feature had a 32% higher non-highly compensated employee participation rate, and then when combined with an auto-escalation feature, had a 40% higher non-highly compensated employee participation rate compared to plans without these features. So what this translates into is an improved non-highly compensated employee ADP testing results for respect to non-safe harbor plans, and therefore reduces the possibility of corrective distributions to highly compensated employees. Policymakers on both a federal level and more recently on a state level view auto-enrollment as a useful tool to help remedy the lack of retirement savings among private sector employees, and for having a positive impact on reducing poverty levels in retirement. Next slide, please. Automatic enrollment options. The automatic contribution arrangement is the most basic of the automatic enrollment options. A plan can adopt this feature to apply to only newly hired employees, or to only newly eligible employees, or to all employees with an affirmative election to defer. And this can be adopted at any time during the year. Typically a default percentage is selected, and a default investment fund is designated by the plan sponsor. The deadline to complete and correct 401k non-discrimination testing, the ADP testing that was mentioned earlier, still remains at 2.5 months after the close of the plan year. However, there are no required employer matching contributions. Now, EACAs, the eligible automatic contribution arrangements, must start at the beginning of the plan year, so you can't adopt this during the year like with the ACA. Plan sponsors may also adopt a feature that allows automatically enrolled employees up to 90 days to opt out, a grace period, if you will, and receive a distribution of their contributions. The deadline to complete and correct 401k non-discrimination testing, the ADP-ACP testing, in this case is increased to 6 months. And so instead of 2.5 months, like under the ACA, it's increased to 6 months after the last day of the plan year. So that might give more time to make corrections if they're necessary. Features must apply to all employees. And again, there's no employer matching contributions required. Now, the qualified automatic contribution arrangement, QACA, has a safe harbor arrangement. It qualifies for a 2-year cliff vesting, so that means you could have 0 vesting on the first year and then 100% on the second year of service. And auto escalation is required unless the default enrollment rate is at least 6%. So the 2 safe harbor formulas that are available, is now we have required employer matching contributions, are first 100% of the first 1% deferred plus an additional 50% match on the next 5% deferred for a maximum of 3.5% for those folks that defer 6% or more. The other formula is just the normal straight 3% non-elective contribution that's eligible for all eligible participants. So the benefit here is there's no ADP-ACP testing required. And if there's no other employer contributions, or if there's forfeitures that are allocated during that year, there would also have the benefit of no top-heavy testing. Next slide, please. So this kind of reviews what we discussed earlier. The benefits are increased non-highly compensated employee participation rates, which improves annual employee testing results and can result in higher retirement savings and lower poverty rates. Some important considerations. This might be the time to contact your account manager at Nova and ask him or her to generate some illustrations of the various matching formulas that are available so you can estimate the amount that should be budgeted should you adopt one of those arrangements. But there are some additional administrative considerations when you have these arrangements. You'll more likely have more accounts that you'll need to monitor and maintain. Plus, if you're a company that has high turnover rate, you may have increased distribution processing of a lot of small account balances. There also will be some timely notice requirements and some employee communications. And your payroll provider to record keeper data flow must be timely and accurate to avoid having to make any corrections. Next slide, please. So auto-escalation. The plan document states what the annual incremental increase is for each year and what the maximum is after a period of years. For example, some employees may start at 3% and increase by 1% incrementally each year until a maximum of 10% is reached. These options are permitted in each of the 3 automatic enrollment options. However, the QACA has some additional requirements, and recently the escalated cap has increased from 10% to 15%. Those extra requirements are that QACAs must satisfy what's called the minimum and maximum default percentage contribution requirements. The default percentage must be at least 3% in the initial year, year 1, then in the subsequent year at least 4%, and then in the third year at least 5%, and then from the year 4 and subsequent years must be at least 6%. And these escalations usually occur annually as a best practice. Next slide, please. Now let's transition to loans and hardship distributions. Many studies have shown that eligible employees are more likely to defer when a participant loan and/or a hardship distribution features have been adopted by their employer's 401k plan. So the general characteristics of a participant loans. Generally, it must be repaid within 5 years. However, there is an exception for the purchase of principal residence, where 20, 25, and 30-year terms are permissible. Loans must bear a reasonable rate of interest. A typical rate used would be the prime rate, an easily found published rate, plus 1% or even plus 2%, are found often in loans. And then loan repayments must be made with level amortized payments at least quarterly, although typically they're made on a payroll basis more frequently than quarterly. The repayments must be made by payroll deduction and only one outstanding loan at a time. These are both typical best practices. You don't want to be trying to chase down payments for loans. You want them to be automatic through your payroll service. However, you can restrict the available money sources. Your plan document can restrict access to certain money types. For example, if you're an employer that may take on a more paternalistic view to retirement savings and not permit distributions from employer sources such as safe harbor, the matching, and discretionary contributions. In other words, restricted only to the monies that the employees actually deferred. And then, of course, loans can be taken for any reason. For hardship distributions, these do not have to be repaid, and they're taxable distributions, and they're also subject to early withdrawal penalties for those under age 59 and a half. You can only take the amount that satisfies the immediate and heavy financial need, and likewise can restrict to available money types, like with participant loans. Next slide, please. Safe harbor hardship distributions. There's 6 safe harbors. There's one for medical expenses, for reimbursement of the purchase of a primary residence, excluding mortgage payments, for tuition or related educational expenses for the next 12 months for post-secondary education, Can be used to prevent eviction or foreclosure from your principal residence. Can be used to pay for funeral expenses, and can be used for payment of expenses related to repair of damage to your principal residence. However, the caveat here is that to qualify, they must be a federally declared disaster area to qualify as a deductible casualty expense. Next slide, please. So for loans and hardship distributions, there are some important considerations. First of all, loan and hardship distribution fees for processing them are typically paid by the participant making the request. And generally, there'll be an administrative fee paid to the TPA and to the record keeper. And in some cases, a 1099-R production fee may also be applicable. So there's some additional administrative work. With respect to loans, someone will need to review the online or paper requests for accuracy, to make corrections when necessary, and to seek approval by the plan trustee or other authorized representative. Moreover, amortization schedules, promissory notes, and security agreements must be prepared and provided to the participant in the payroll department so that the correct loan repayments can be withheld from the participant's paycheck. With regard to hardship distributions, likewise, someone will need to review online and paper requests for accuracy, make corrections when necessary, and seek approval by the plan trustee or other authorized representative, and then distributed per the direction of the plan participant. Now, employee requests. Processes must be in place at the employer's office to help facilitate employee requests for participant loans and for hardship distributions. For example, what's typical is you would have some online instructions available to them and or paper forms that are necessary for making such requests. Next slide, please. A new optional in-service withdrawal. It's a qualified birth or adoption distribution, also known as the baby distribution. This can occur within 1 year after birth or adoption, up to $5,000 per birth or adoption. It does require a plan amendment to qualify. And repayment options are also included in the legislation. However, there's not a lot of guidance yet as to specifics. I mean, many questions have been asked. For example, $5,000 per child. Presumably, there's no limit to the number of children and adopted or born for that credit would apply. Must plans accept repayment? Probably. What is the deadline for repayment? We haven't been given guidance on that. What happens when an employee terminates after taking a qualified birth or adoption distribution, or otherwise known as a baby distribution? What happens at that point? We don't know. Clarification about repayments that don't need to include interest like a loan. And then further, be more detailed and clarify what expenses can be paid with that qualified birth or adoption distribution money. Next slide, please. Long-term part-time employees, LTPTs. Generally, a plan sponsor may not expressly exclude part-time employees. In other words, employees that work less than 40 hours per week from making a 401k plan salary deferrals if they would otherwise satisfy eligibility requirements. However, careful wording in the plan document, such as the following phrase, the plan excludes part-time employees defined as any employee who has not yet completed a year of service and 1,000 hours as based on the Internal Revenue Code's minimum service rules would be an acceptable way to exclude part-time employees. Whereas wording such as the phrase, the plan excludes part-time employees defined as any employee who works 20 hours or less per week would not always work, because you can think of an example where a particular employee or employees worked 20 hours per week. Upon the 50th week, they would reach the 1,000 hours, and then they would be required to have eligibility in the plan. So some of those formulas are good, some of them don't work. So effective 1/1/2021, under the new rules, long-term part-time employees who work at least 500 hours in 3 consecutive years and have attained age 21 must be allowed to participate in the 401k plans. So we're going to have to start measuring hours beginning with the 1/1/2021. So before we typically were only concerned mostly about people who worked 1,000 hours or more. Now we need to be more careful so that we can track these things. And so over a 3-year period, it's possible that we may start seeing some of these as early as 1/1/2024, after there have been 3 consecutive years of 500 to up to less than 1,000 hours. Next slide, please. Long-term part-time employees can be excluded from safe harbor and discretionary employer contributions and compliance testing, so we're grateful for that. If employer contributions are provided, again, this is optional, and the contribution is subject to a vesting schedule, then we'll have to be careful and note that the vesting year service for long-term part-time employees would be 500 hours, where typically vesting schedules require 1,000 hours or more to move up from one level of vesting to the next. However, if a long-term part-time employee works 1,000 hours, must be treated like any other employee. In other words, if there was employer contributions, those are no longer optional. And we're expecting a lot more guidance on this. So basically, 401k plans are going to have to be amended to have dual eligibility requirements. An employee can then become eligible for the plan by fulfilling either one, what we're used to, and that would be the 1 year of service with 1,000 hours of service and during a 1-year period, and also have attained age 21, what we're typically used to, or now, in the new rules, the 3 years of service requirement, where at least 500 hours of service have been worked for 3 consecutive years and of age 21. Next slide, please. Required minimum distributions. Here we had some movement finally. The required beginning date has increased to age 72. Now this is effective for participants who attain age 72 after 12/31/2019. In other words, those folks that have a birth date on or after 12/31/1947. As before, active non-owner employees can still choose to defer until termination of their employment. And also, as before, active and greater than 5% owners are still required to take the required minimum distributions, just now at age 72 instead of 70.5. And one other caveat, with the CARES Act, required minimum distributions are suspended for calendar year 2020. Next slide, please. COVID distributions and withdrawals under the CARES Act. There was some relief here. Up to the lesser of $100,000 or 100% of the participants' vested account balances can be considered for the distribution. And the employee provides the certification. So it's a self-certification, and there's no documentation required to be provided to the employer. The employee will self-certify that either themselves, their spouse, or a dependent has been diagnosed with COVID or has experienced an adverse financial consequences as a result of COVID. Their hours were cut at work, their compensation was cut, something where there's something measurable. Now, this is an optional item. However, we have included it in the plan as a NOVA default unless the plan sponsor has told us to opt out of this feature. Now, distributions will be taxable. However, they will not be subject to the usual 20% mandatory withholding or the 10% early distribution penalty if you're under age 59.5. However, taxes will still be due, but they'll be spread over 3 years unless the participant elects otherwise to pay more frequently than 3. So what's interesting is that they can be repaid over a 3-year period to not only this plan, but or to an IRA. Say the person terminated service or let go, they could make the payments back to their own IRA. Now, this is a feature, an opportunity that's only available between January 1st of 2020 through December 31st, 2020. Next slide, please. Now we have COVID loans. This is also an optional feature in the plan. The same qualification and employee certification criteria as described earlier with the COVID withdrawal and distributions apply. Here, the increased loan limit have an increased loan limit where typically it was $50,000, has been I think since 1986. In this case, you're allowed to increase to the lesser of $100,000 or 100% of the participant's vested account balance. Now this applies for a shorter window between 3/27/2020 and September 23rd, 2020. There's also some relief in terms of repayments. There's a repayment suspension allowed to extend the term of the loan for up to 1 year. This applies to new and existing loans. However, interest will continue to accrue, and existing loans will need to be caught up or re-amortized beginning 1/1/2021 to accommodate that interest that accrued during the time in which they didn't make payments. Again, this is an optional feature in the plan. It's been included as a NOVA default unless the plan sponsor has opted out. So it's only for plans with a plan provision, and as long as they did not increase the number of loans as well. So next slide, please. Okay, so now let's transition to some plan designs in this area here. So one of the things to keep in mind, I always ask my clients is, let's start with determining what are the business and retirement objectives. You know, what are the reasons that you're sponsoring your plan or plans? And so a few things that we look at in general will be possibly restructuring the matching employer contributions, perhaps reducing or increasing those contributions, or changing the manner in which discretionary contribution formulas allocate those resources. So you could, you know, again, this is a time to talk to your NOVA account manager so that he can look at those things and offer suggestions for revisions. And there's also considering redesigning your contribution allocations, new comparability allocations. This could allow us to put different allocation groups like are listed here. Direct owners could be in a separate group. Their lineal descendants could be in a separate group. All other highly compensated employees that aren't related to them could be in a separate group. And all other employees can be in a separate group or different groups. And so this will allow you to more accurately allocate funds to those people that you wish to reward more favorably, such as people who are more responsible for the profits of the company. So again, this is a great opportunity to review your objectives and budget you might have for funding with your NOVA account manager so that he or she can offer some suggestions for revisions. For employers that only sponsor a 401k plan and have the budget and desire to fund more, they may want to consider combining their existing 401k plan with a cash balance plan or a 457 plan. So again, here, this would be a great opportunity to contact your NOVA account manager to review this possibility in more detail. Next slide, please. Don't see anything on there. There we go. Okay, so let's transition to the plan amendment section. So here you want to consult with your account manager to ensure desired changes meet your business goals and objectives, your retirement goals. And so, for example, go ahead and go on to the next slide, please. NOVA will be amending and restating 401k plans onto IRS pre-approved plan documents. So here's another opportunity to talk with your account manager to ensure the desired changes are meeting your goals. You know, next slide, please. I think we got to go one more. There we go. Okay. So plan amendments are required for these changes. There's various deadlines for amendments, the Secure Act and CARES Act, but both must apply operationally. Next slide, please. We need to go one more here. Okay. So here, we found by experience that it's best to contact your account manager no later than October 1st to ensure there's sufficient time to prepare for any illustrations or amendments. What we want to do is we want to make sure we have plenty of time to work with you before the holiday season is upon us, where it might become more difficult to reach the decision makers and to review changes and do different illustrations and then obtain the signatures on those documents. To help facilitate this process, Nova uses DocuSign to obtain all necessary signatures electronically. Next slide, please. So let's briefly review investment strategy versus inventory. More is not always better. There's a number of studies that show that as the number of investment choices increases, the participation rate decreases. This could be because there are too many options, can result in a choice overload for the participants. It can lead to what sometimes is called as decision paralysis, the fear of making a bad choice when confronted with too many choices. What we seem to find is that the average defined contribution plan has about 19 investment choices. This appears to be the highest number that doesn't overwhelm most participants. Next slide, please. Target date funds. It's a great choice for QDIAs. A QDIA is a qualified default investment alternative and is typically used when a participant fails to make his or her own investment elections. So target date funds have overwhelmingly become the favored QDI choice among fiduciaries. They provide a diversified portfolio in a single fund. The target, works out really well. There's also the time horizon-based investment strategy. Target date funds typically mix several types of stocks, bonds, and other investments to help participants take on more risk when they are younger and then gradually over time become more conservative in those allocations. Next slide, please. Fiduciary risk and investments. It's always a good idea to establish an investment policy. In general, you can even go even further and establish what's called an investment policy statement, or IPS. This would provide the basic investment goals and objectives of a client, and that would also agree with the strategies that your portfolio manager would employ to fulfill those objectives. Now, although this is not required, the investment policy statement, when followed, may help reduce fiduciary risk by addressing prudent processes used for selecting and monitoring investments. And next slide. And I think that with that, we made it through our presentation just before 2 o'clock. So please feel free to call or email Sue Harper or myself if you have any questions or if we can be of further service to you. And I want to thank you again for attending Nova's presentation today. So with that, let's turn it back to you, Andrea.
All right, thanks, Mark. On the screen right now, we do have Nova's webinar link. We offer several webinars throughout the year. Intro to 401k plan sponsors, which is really good, especially if you have somebody new working in your HR department, or if you just want a quick refresher, that one's great. We have another webinar that specifically goes over loan and distributions. So please check out our website. And again, if you'd like to attend a webinar, just click on the registration link and then add that to your calendar. Mark, it looks like we did get one question. Jasmine, do you want to go over that one?
Yes. So they asked, for employees impacted by COVID, can the plan make available both loans and distributions, or does it have to be one or the other?
That's a good question. It can be one or the other or both. They're both optional features. It's just that you'll have to make sure that we let us know here at NOVA, because we have to add that as an amendment when we restate the documents here next year. So one or the other or both is fine.
Thanks. And that's the only question we received. So do any of my other NOVA panelists have anything to add?
Nope, I think we're good. On the screen right now, we do have Sue and Mark's information. If you have any specific webinar questions, we do have contact information, but I think Jasmine will go ahead and provide that to you. Jasmine, do you have any closing comments?
Yeah, so thanks everybody for joining us today to talk about plan design and features for 2021. The webinar session is being recorded and the recording will be made available within approximately 5 business days on our NOVA YouTube channel for future reference. If you do have any questions, please email them to your account manager or webinars@nova401k.com, and everybody have a great day. Bye.
Thanks everyone. Have a great day.